Right then, Morgan's in the building, looking like he's about to tell me my stock portfolio is suboptimal. Mate, lose the gilet. You look like a fund manager from a 90s movie.
Good one. And Chris is here, looking like he hasn't slept since the last Bitcoin halving. Oi, your eyes are redder than a sea of stop losses, bruv. Let's be having it.
Cheeky. All right, listen up. We're going dig today. Proper grown-up stuff.
Right.
How to manage a fully systematic portfolio. That's CMT level 3 territory for the nerds in the chat. So, Morgan, for everyone who thinks trading is just, YOLOing into a coin because some geezer on Twitter put a rocket emoji next to it.
Yeah.
What is a systematic portfolio?
In it, look, put it this way. It's about building a robot trader. A robot. You spend your time being the architect, designing the rules. Then you just let the robot do the dirty work, executing the trades.
Okay.
No emotion, no hesitation. Just cold, hard logic, 24/7.
A robot, you say? So you've basically made yourself redundant.
You kick back with your feet up while a bit of code does your job.
Sounds dead lazy to me, mate.
It's called working smart, not hard. Think about it. When your favorite shitcoin decides to do a minus 30% candle in 5 minutes, you're fumbling for the sell button, probably bricking it, right?
Yeah.
My system, it doesn't feel a thing. It sees the predefined exit point, the stop loss, and it's out. Clean.
Right.
It doesn't care if Elon's dog tweeted.
Okay, I'm with you on the emotion-free part.
Hmm.
My emotions have cost me a house deposit a few times over. So what are these rules then? What's this architecture you're on about?
The architecture is everything. It's 3 main pillars. First, signal generation. Okay? This is your reason for entering a trade. In my world, that could be the FTSE 100 breaking a 6-month high.
Right.
It's a clear, non-negotiable signal.
Right. Your entry trigger. In crypto, that could be a bit different.
Yeah.
Maybe a signal is when the funding rate for a perpetual swap goes mega negative, suggesting a load of shorts are about to get squeezed.
Exactly.
It's a specific, measurable event.
Exactly.
Pillar 2, and this is the one people always mess up, is position sizing and risk management. This is where you decide how much ammo to use. A systematic approach forces you to define, down to the penny, how much you're willing to lose before you even click buy.
Ah, the stop loss. Or as the crypto degenerates call it, the liquidation price.
Right.
The thing everyone sets and then drags down just a little bit more when the price gets close.
And that's the fatal flaw. The system is ruthless. It doesn't have hope.
Yeah.
The rule is the rule. This is the core of it. You backtest the rules on years of data, you prove the statistical edge, and you trust the process.
Wow.
You remove the weak link, which is you. Backtesting. So, running your robot on history to see if it would have made you a millionaire, it still feels a bit like looking in the rearview mirror to drive forward.
Right.
How do you know the past will repeat? You don't. And that's a massive trap called overfitting or curve fitting.
Okay.
Anyone can build a system that perfectly navigated the 2008 crash in hindsight. The real skill, and what the CMT stuff really hammers home, is building a robust system.
Right.
One that isn't just tuned to one specific historical period.
Okay, so how do you build a robust one then?
So
How do you avoid the hindsight trap?
you get clever with your testing. You do walk forward analysis. You built the system on data from, say, 2010 to 2015. Then you test it out of sample on 2016. Then you retune and test on 2017.
Okay.
You're constantly checking if it adapts. And you have to factor in real-world costs. Your backtest has to include slippage and trading fees. Otherwise, it's just a fantasy. That's actually pretty street smart. You're stress testing the robot before you give it the keys to your Lambo fund. Yeah, but I got to ask, mate. Isn't it a bit, boring, soulless? Where's the art, the thrill of nailing a market call? Mate, the art is in the design. That's where you put your genius. Your grand theory of how markets work gets coded into the rules. Is it a trend-following system? A mean reversion system?
Right.
That's your masterpiece. Once it's built, I don't want my thrill anywhere near the execution button. My gut feel buys tops and sells bottoms. My system grinds out profit.
I feel that.
That little voice in your head when you're 100x up on a dog coin, screaming, "It's going to $1," while the chart is screaming, "Get out, you plum." Yeah, and the system just gets you out. It takes the profit, no questions asked.
Wow.
It doesn't have a mate down the pub who told him it's the next big thing. It just follows the rules. It's the discipline of the big quant funds, but you can build it yourself.
All right, let's make it practical for the listeners. Say I want to build a dead simple, systematic strategy for Ethereum.
Okay.
What are the building blocks? Walk me through it.
Easy. Block 1, the signal. Let's go super simple. A long-term, trend-following signal.
Go on.
We buy Ethereum when its price closes above the 20-week simple moving average for 2 consecutive weeks.
Okay.
We sell when it closes below for 2 consecutive weeks.
Got it. Simple, slow, and removes the weekly noise. I'm with you.
Block 2, the risk. This is non-negotiable. We will risk a maximum of 1.5% of our entire portfolio on any single trade.
Right.
We place a hard stop loss 20% below our entry price. Now, the magic is these 2 rules dictate your position size.
Hold on. Let me get my head around that. You work backwards.
Yeah.
You know your max loss in pounds, like £150 on a 10k portfolio. You know the stop loss distance in percentage, 20%. So you calculate the exact amount of ETH to buy, where that 20% drop equals exactly £150.
See? Now you're thinking systematically. It's just maths. It stops you from just aping in your whole stack. And finally, block 3, portfolio management.
Okay.
Let's say you also own Bitcoin and some stocks in this portfolio. You set a rule, no single asset shall be more than 40% of the total portfolio. If your ETH position moons and becomes 55% of the portfolio at the end of the month, the system automatically sells a bit to bring it back to 40%.
That's the part that kills people though, isn't it? Trimming your winners.
Yeah, it is. It feels so wrong, but I guess you're banking profit and reducing the risk of one asset blowing up your whole spot. It's called rebalancing. It's professional risk management, not hodl gang till zero.
Right.
A systematic portfolio is designed to survive any market and grind out returns over a decade. It's not about that one heroic trade that you tell your grandkids about. It's about a process that actually works. You've almost convinced me, It's less cowboy dipdo trader and more like trading engineer. Exactly. I suppose there's a reason the big boys, the massive hedge funds, are all quants. They're not guessing. Exactly. They're not built on heroes.
Right.
They're built on systems. The system is the edge. Solid gold, mate. Proper alpha there. All right, before we bounce, listen up, everyone. We've got a chat group. It's going off. The link's down below. If you're signing up to a new Crypto CX, use our ref link to support the channel. Proper appreciate it.
Yeah, do it.
Hop in the group, have a laugh with us, tell Morgan his gilets rubbish.
Oi, have some respect. Get in the chat.
Right, we're out. But before you go, here's a question we want you to think about.
Ooh.
If you had to build a single, simple rule to manage your entire portfolio, just one if-then statement to prevent you from making your biggest trading mistake, what would that rule be?